for $500,000. What should you do when your stocks go down? A. Buy more. B. Sell some. C. Sell all. Or D. Do nothing. Yes, I know this. It's gotta be buy, right? That makes the most sense. You buy more stocks when they're down. Or is this too simple? Am I overthinking it? I didn't say why the stocks went down. Maybe the company's bankrupt and I should sell. No. Or should I just wait and do nothing? I'm overthinking this. It's gotta be buy, right? I wish I didn't use my lifelines. There's no avoiding it. This is the one question that every investor will eventually have to face. How you respond when stocks go down will be a key determinant of your future returns from investing. However, unlike in the intro, it's not always 100% cut and dry exactly what you should do and can depend on your situation and the stocks you're dealing with. In this video, we'll go over 5 strategies that actually work and can set you up for success for how to react when your stocks eventually do go down. These strategies apply during a general market downturn when most stocks are down or in a bear market. However, this is also applicable to individual stocks within your portfolio, which might see significant price declines. The first piece of advice I would have for you in these situations is to remember to maintain a long-term focus when you're thinking about investing. In the short term, stock prices are nearly impossible to predict, with some stocks having high volatility and seeing very large price fluctuations. If you end up getting too caught up in the day-to-day movements of the stock market, you'll end up missing out on the bigger picture. When you think about investing for the long term, you want to think about investing for years and decades, not just weeks and months. Unlike gambling on the Logan Paul KSI fight, long-term investing is a game where the odds are in your favor. Over the long term, stocks tend to follow the performance of their underlying businesses. Understanding this concept can help you to tune out some of the market noise that you see day to day in the markets. It's important for you not to become any market irrationality, but instead take advantage of it. If you see a company that you're interested in whose stock is trading at a valuation below what you reasonably believe the business is worth, then that would be a good opportunity for a long-term investment. While short-term investors get discouraged by short-term price movements, long-term investors look for potential buying opportunities. So with all that being said, from a practical perspective, when does it make sense to buy more stock? When does it make sense just simply to hold and do nothing? And when does it actually make sense to sell your stock? In this case, we'll look at the buy strategy first. So let's say your stocks just experienced a price decline. This could be an individual stock that you have in your portfolio or all of them as a general market decline. Should you buy more? To me, market or stock declines are typically opportunities where I might be able to purchase stocks of good companies I like that are on sale. Just like for when you see a sale on an item you're thinking about buying, you should be more interested in buying stocks that you want after a price decline rather than just their previous price. Especially for people who are indexing or strictly buy and hold investors who are deciding that they're not going to strategically sell off any of their positions, then it makes particular sense for those investors to be buying more after a price decline rather than before. This is because if you're going to be buying and then holding for the very long term, you want to buy at the lowest price possible. When these price declines or special stock sales come around, you want to take advantage of them by loading up in bulk. If you're a long-term buy and hold investor, stock crashes should actually excite you. In this respect, if you have cash available to deploy after a 50% market crash, it's almost like you've gotten a 100% return on that cash because now you can buy double the amount of stock than you could before. This applies both to the general market index as well as individual stocks you may be interested in buying. So that's the buying case. But what are the situations where you should actually just hold onto your stock and ignore the market noise for now? There are some situations where it makes sense simply to do nothing. One of these situations would be if you simply do not have the extra capital available to invest at this time. Perhaps you already invested your cash cushion and no longer have any cash available to invest in new stocks at lower prices. Alternatively, maybe your financial situation has changed where you're less willing to take on risk in the markets. Another case for individual stocks is if you already have a full position and no longer wish to allocate any more capital to a certain stock, even if the prices decline further. In this case, there's not much more added benefit for you to follow daily price movements either of the market or of your individual stock positions. In some cases, this may end up actually being a detriment to you if you end up being emotionally influenced by sudden stock movements. This can be particularly hurtful to your returns if you end up making an emotional decision to sell after a recent price decline. In these cases, I might actually recommend that you go on the stock low information diet. Now, what this low information diet is that you take a break from looking at the daily prices of your stocks or your portfolio and only take a look at it over the weekends when markets are closed. The reason for this is the amount of price information that you can get, even during a single week, can get quite overwhelming. Even if you have a relatively small portfolio of just 10 individual stocks, if you end up checking their prices twice a day, that's 20 prices to process in a single day, which means you're processing 100 new prices every single week. Especially if you're financially unable to act on this information, then there's not really an added benefit for your brain being overloaded by all these stock prices. If you just take a look once during the weekend, you now have just 10 prices to look at per week instead of 100. This cuts down the amount of price information by 90% and allows you to focus more on long-term thinking about your portfolio. Oftentimes, with so much information coming at us every single day, we are under the pressure to maybe make actions at that same pace as well. However, in long-term investing, patience is rewarded, and you're not necessarily going to do better, and oftentimes you'll do worse by trading more frequently. Now, the counter argument to not looking at the markets every single day would be, well, Michael, I might miss out on a great opportunity that might come during the middle of the week, and if I wait till the weekend, well, then I've missed it, and now my opportunity's gone. And to that, I'd say that that's usually not the case. I'm open to hearing any specific counter examples to this, but for the most part, usually when there's a significant stock decline, there's at least another opportunity to purchase the stock at that price during the next week. If not the next week, then maybe the next month, but it's rare for you to be able to catch the market bottom in a single week. Waiting for the weekend gives you time to process the information from the prior week and allow you to make more of a rational decision for the week going forward. Now, if you can handle the daily information just fine, go for it, stick with it. But this strategy can be helpful for buy and hold investors who don't necessarily need the day-to-day noise of the market coming at them every day. So when does it actually make sense to sell your stock after a recent price decline? Now, on first glance, this may seem kind of like a big red flag, right? You're buying high and then selling low. That's not really how it goes, right? And to that, I'd say yes, you're generally correct there. However, during stock declines, it'll be an opportunity for you to reevaluate your position. This is particularly important if immediately after finding out about the price decline that you start reconsidering your position on the stock. What this tells me is that you actually had a low long-term conviction on this stock. This is likely caused by two main factors. The first of which is basing the primary reason for buying your stock based on relatively recent price performance. For some investors, fear of missing out on a significant stock rally can lead them to chase performance and buy in well after much of the rally has occurred. They're basing their investment decision on the expectation that recent price trends will continue into the future. This kind of extrapolation is dangerous because any financial firm will tell you past results are not predictive of future performance. This is often coupled with the second aspect of a low conviction stock, which is that you've done not enough research on the stock to begin with. If recent price momentum is the main reason for you investing in a stock, it's likely that you haven't done the required research on the company fundamentals and the business as a whole to make you comfortable holding this pick for the long term. Alternatively, you might have heard this stock pick from someone else or someone that you trust, or even me, which is not enough on its own for you to be making investment decisions. Doing your own research is a required prerequisite before you do any type of investing. Don't rely just on what someone else has said. I like to talk about stocks and investing on this channel, but I never recommend an individual stock to anyone. I simply provide my view for investors to learn from and to be a springboard for them to do their own original research. Know the companies that you're getting into before you invest in them. If you end up investing in a company and you realize later that this is not a company that you actually want to be invested in, or it's above your risk tolerance, then it can make sense to simply scrap the position and sell off regardless of whatever the recent price movements may have been. This is because simply that stock does not fit into your investment thesis and doesn't really hold a place in your portfolio at this time. However, it's also possible that you could have invested in a stock without doing the prior research, then later on did the research and became comfortable with the position. In that case, and only in that case if you've done the required research, is it then okay to hold on to that position going forward. And finally, the last point would be don't focus on beating the market and relative performance. Focus on absolute performance and what you need to achieve your financial goals. One of my pet peeves is that when investing, a lot of people will compare their investment performance to that of a market index like the S&P 500. The issue with this is that it's completely irrelevant to the point of investing, which is to help achieve your financial goals. If the market tanks by 40% and you only lost 30%, you're not really going to be patting yourself on the back. Alternatively, if the market's up 30%, but your portfolio only got a measly 25%, that's no reason to feel disappointed. Instead of grading your financial performance on a relative basis like comparing to an index, focus on the absolute returns you need to achieve your goals. In this case, it can help to set realistic expectations about what you'll actually return when you're investing. For example, I like to invest in opportunities where I think I can get at least a 12% return on investment. However, given that a significant portion of my portfolio is cash, the total return I expect on my portfolio is maybe closer to around 6 or 7%. Given this, I don't really care what the market does, and I'm more concerned about my individual performance and trying to achieve my own financial goals. In short, stop comparing yourself to other people's returns and the market, and focus on you and what you can control. I hope after watching this you feel a little more prepared for when your stocks go down. As always, thank you guys for watching. My name's Michael, and I will see you in the next video.